You are welcome and very good morning to all my dear students of Government Facility College Gauri and all other students. This is one more presentation of another chapter, which is the valuation of goodwill. So I have shared the screen over here, right, which is valuation of goodwill. For better understanding what is necessary, I have already told you that make the notes of it when I sent it, right? It's there in the group PDF format. The same is being displayed here in your front, correct? So make the notes, understand it, write it, practice it. Subscribe to my channel, SSD Benchmark, if you have not done it. So let us see what is valuation of goodwill. Valuation, right? That means you are in the process of ascertaining the correct value of the goodwill. So that means you are going to measure the goodwill or reputation in terms of money. Usually, the goodwill is an intangible asset which is actually measured and which would be more than the true value of assets of any business. For which introductory class, which yesterday I've taken, I've already briefed you about how the goodwill or reputation is being built. Two important aspects. One is you need to contribute to the top line, and the other one is bottom line. So top line refers to the sales and bottom line refers to net profits. Okay. In any of the business, if you are looking towards increasing the bottom line, and the top line has to and must and should increase. I mean to say, over a period of time, you put very hard work. Who? You means you're the business person, right? The one who is running the business. He puts in lots of work, right? Efforts he takes, and he is going to have new ideas to actually promote the business, right? To develop the business, to transform the business one state to another state. So hence, goodwill, let us see, it is the extra value attached to the business over and above the intrinsic value of its net assets. It's very, very important. Means the total assets value and the goodwill, if you compare, the goodwill is more. For example, net value of assets means assets value minus liabilities value. The difference is net assets usually. For example, total assets amounting 10 lakhs. Liabilities to outsiders amounting 2 lakhs. Then the difference is 8 lakhs is the net assets. So, but if you want to purchase that particular business, the owner of the business would not be charging 8 lakhs. He would be charging minimum 16 lakhs. That means 8 lakhs extra. What is this extra? This extra is known as value of reputation or good name of the business. Okay. So definition here, see one or two definitions. According to the spices, the spicer and peddler, it is not spicer and spices, it is spicer and peddler. What did he say? Goodwill may be said to be that element arising from the reputation. Remember, reputation, connection, and other advantages possessed by a business which enables it to earn greater profits than the return normally to be expected on the capital represented by the net tangible assets employed in the business. This is the self-explanatory definition according to Spicer and Pegler. They say how the goodwill is being means actually acquired or it is being earned. Number one, good reputation you need to have with the customers and in the business. Very good network you need to have. That is what connection is all about. And various other advantages. For example, the employees in your concern, they are working very hard. They are dedicated, right? They have employable skills. Okay. So their way of thinking is much ahead than the thinking and the way of functioning of all other business concerns. Okay. And the board of directors are highly intellectual. They have very good reputation by studying in various reputed top universities across the globe. These factors will influence increase in the value of goodwill. Means the same business which is being done by A and B, but A company is getting normal profits and B is getting abnormal profits, means over the above, then B company enjoys the goodwill. So according to P.D. Leak, one of the author, he has classified, this is a classification, just dog goodwill, cat goodwill, and rat goodwill. This is self-explanatory. Just go through the explanation that has been given. He says, dog goodwill. See, dogs are attached to the persons, and such customers lead to personal goodwill, which is not transferable. See, dog goodwill, see, dog is an animal, right? It is very familiar for the synonym word called loyalty. Dog is famous for loyalty. That means it is very loyal to the person that is the owner. So it means this type of persons who have this dog kind of good, it is a characteristic feature. They stick on to only one supplier, only one business person. They don't want to change. Similarly, cat goodwill. Say they prefer locality. In that locality, whatever the shops they find, only from such shops they will buy. These customers. See, dog is customer, characteristic of customer. Cat is characteristic of customer. Rat is also characteristic of customer. So rat goodwill, the one who belongs to this category, they, okay, neither to the person, they stick on to the neither to the person, nor to the place. It is not like that. So these type of customers, those who have rat goodwill, they don't stick on to the place. They don't stick on to the person. Wherever they go, so cutting, that means eating any stuff, biting any stuff is a characteristic of rat goodwill. That means customers have been categorized into dog, cat, and rat, depending upon. But that is irrelevant, of course, here, but which has been meant here, so it is to be learned by you. Then, what are the features of goodwill? Main characteristic features. See, goodwill is an intangible asset. It cannot be seen or touched, but you can feel the goodwill. Goodwill is a real asset, okay, not a fictitious asset. So goodwill always exists with business, but it cannot exist by itself. Then goodwill is subject to fluctuations. It keeps changing. These are all the points, okay. Then what are the factors determining the value of goodwill? Okay. So what factors determine? That means whether the value is more, that means goodwill is more or less. How do you depend, right? So these factors. So these are all the self-explanatory. So you have to go through once again, read the stuff that has been sent. Number one, location factors. Okay. The geographical locality of the business influences goodwill. Suppose your industry or the business is located in rural area, the value of the business that means value, that is goodwill valuation always will be lesser. Suppose your industry or the business is located in urban area, then it enjoys more benefit. That's what location. Time factor. Okay. So suppose a long-term business, suppose a business which is having its existence since, let us say, 50 years, 60 years, 100 years, then this business enjoys more value comparatively. The business just established 2 years before, 1 year before, 5 years before, because the time matters here. Okay. Then the nature of business. Okay. So nature of goods dealt with, the risk attached, the competitive, the competition involved, the privileges enjoyed by the firm, etc. These determine the value of goodwill. That is nature of business. What type of business you are doing, correct? Is it service oriented, product oriented? Depending upon which, so the business, valuation of goodwill differs. So efficiency of management, of course, board of directors are who run the business, proprietor, his capability. If he has more risk-taking ability, normally reputation will be more, right? Valuation of goodwill is also more. If they don't work similarly, then the valuation of goodwill also will be lesser. Past profits of a business, of course. So previously, whatever the profits earned by the business is going to determine valuation of business. Stability of a business, this is also another factor. Future prospects of a business, there is an explanation over here. Please read yourself. Then other factors like economic conditions, political stability, government policies, money market conditions, trade cycles. These are all the factors which influence the valuation of goodwill. Now the question comes, why this particular valuation of goodwill is to be required? Number one, in the case of a sole trading concern, it is a small business. When a sole trading concern is sold, so you have, for a sufficient period, you have run the business. Now you don't want to continue. Now you want to sell it. Yes, there is reputation or goodwill valuation is necessary. When the sole trading concern is converted into partnership, and when it is amalgamated with another sole trading concern, there are three important instances when the valuation of goodwill is necessary. Okay. So when you convert, correct now, that means you, previous semester you had one chapter in the financial accounting. What was that? In financial accounting, sale of a firm into a company, correct? Similarly, that when your firm, sole trading firm is converted into partnership, or when it is amalgamated with another firm, then valuation of goodwill is necessary. Why? Because there is a purchaser, there is a seller, correct? There is a vendor, there is a buyer. So vendor is going to accept goodwill from the purchaser of the business. So in case of a partnership firm, when you are admitting a new partner, retirement of your partner, death of your partner, amalgamation of partnership firms. Okay, this is self-explanatory, you know that. In case of joint stock company, an amalgamation, absorption, external reconstruction, and on the acquisition of majority of shares by holding company for the purpose of valuation of shares. For all these purposes, right? So these are all the various purposes for which the valuation of goodwill is necessary. Why I did not explain? Because these are all self-explanatory, which I've already tried to explain in the class itself. Now, the methods of valuation of goodwill. How do you value? There are four important methods. One is average profits method. Second one is capitalization method. Third one is super profits method. And the fourth one is annuity method. Now, average profits method, I have already told you, average profits method means for 5 years profits are given. You add it, divided by 5, you do it, you get the average profits, correct? Into number of years of purchase, 2 years or 3 years. So multiply by 2, you get the goodwill. Very simple method. But there is a procedure for it, correct? This procedure you should be knowing because these profits, before adding, it's very important. If there are any additions, there are any deletions which have to be made, okay, which will be done, then only average profits will be found out, then valuation of goodwill is being done in 3 stages or 3 steps. See, observe here. So the first method, correct? Average profits method. Under this method, the value of goodwill is calculated by multiplying the adjusted average annual profits by the number of years of purchase. What is this here? I've taken adjusted average annual profits divided by number of years of purchase. Profits multiplied by number of years of purchase. Okay. So value of goodwill is equal to adjusted average profits into number of years of purchase. This is a formula. Now let us see. Before ascertaining this, there are methods. Now what do we need? We need adjusted average profits. Number of years of purchase, it would have been given in the sum itself. Let us see this. Okay, this is very important. Steps for valuation of goodwill under average profit method. The first step is calculation of adjusted profits, adjusted future profits, or maintainable profits. So that means 2 years, 3 years, or 4 years, or 5 years. What would they give? They give you the profits. And they'll give you adjustments as well. What are those adjustments? Normally, each year's profit has to be adjusted. Adjusted means what? If, suppose, previous year profit, 50,000 is given, let us assume. And instruction they say, so 10,000 profit is expected from this year onwards. So to this existing 50,000, 10,000 will be added. So it becomes 60,000. Okay. Suppose 5,000 rupees extra expenses will occur in future. Then 60,000 minus 5,000, you get 55,000. Okay. What is that you have done? One income you have added, one expenditure you have subtracted. Okay. So which is known as the adjusted profits. So what is this? You need to calculate adjusted profits first year-wise. So for this particular sum, rupees column you will draw. So here the profit of that particular year you will record. If it is for 1 year, only one column. If it is for several years, 2 years, 3 years, 4 years, such columns will be added here. So now the profits will be taken, given profits in the sum. What is to be added? Always remember. What is that you are doing? You are adjusting profits. Adjusting means what? Adjusting means in future, after purchasing the business, if the business is expecting additional revenue, additional money, additional profits, additional income, such amount should be added. Then, in case if your business expects additional expenses, in case of loss, in case of other type of expenses, which will decrease the profits. Correct? If the incident increases the profit, you will add it. If the incident decreases the profit, you will subtract it. Towards the end, what you would get? You would get adjusted profit. See the format. What is that? Remember, this is very important. You need to write and practice this pro forma. For example, profits will be taken here. All expenses and losses not likely to incur in future. What will be added? all expenses and losses not likely to incur in future. So that will be added. Then, like see, they have given example, abnormal losses, capital expenses, etc., which will be mentioned in the problem. Don't worry about it. So always remember the given profits you will record here. So far, certain expenses were occurring again and again, over and over, every year. But this year onwards, they will not incur. That means you are saving money. So such money has to be added. Then all profits likely to come in the future. I have already told you. If certain profits are expected in the future, days to come, yes, it is to be added. See, if expenses and losses not likely to incur, add it. If additional profits are generated, you add it. For example, profit due to line of new business. New business, you are growing. That means there is an expansion. One more branch you are expanding, correct? In another place, that generates revenue, additional revenue distributed. Then, see here, all expenses and losses expected to occur in future. See here, not likely to occur, added. And here, expected to occur in future, subtract. So what is very important? All expenses and losses which you expect in future, you have to subtract it. So, for example, salary of directors, salary of the staff, insurance on stock in future, depreciation on furniture, cost of management, or any other expenses not covered earlier but to be incurred in future. The next point, profit not likely to arise in future. So that is to be minus. So far there were profits, but after purchasing the business, you will not have the profits. Okay. So it means, see, always remember, all expenses and losses not likely to add. All future incomes likely add. All future expenses and losses to incur minus. The profits which you were getting earlier, now, after the purchase of this business, you will not get more. So no profits in future, minus. So hence, these two to be added, these two to be subtracted. Now you get adjusted or future profit. This is the first stage. Second step, calculation of adjusted average profits. See, for 3 years, these profits are given. So this way you will calculate. What will you do? You will total it. Okay. Total for all the 3 years adjusted profits divided by 3 years, you get the adjusted average profits. But here there are two ways. One is simple average, another one is weighted average. You should be carrying this. Very, very important. What is simple average? What I have told you is the simple average. So that means total adjusted profit of all the given years divided by number of years. This is simple average. What is weighted average? Weighted average, the formula changes. Weighted average, weighted adjusted average profits is equal to total product divided by total weights. Total product divided by total weights. Okay, so this you see here, explanation is given. So go through it. So once I come, definitely I'll explain what it is, right? So here very simple. Each year profits are given, weights are given. Okay, these profits will be totaled. Okay, so you will total the profits, right? And weights will be written in the next column. So both will be multiplied. Now you get total product, total weights. That's it. Total product is numerator, total weights is denominator. For example, if I have to show you, what should I do? Yes, I will write here. Just 2 years only I will write. First year, assume 5,000 rupees is the profit. Okay. and weights is given 1. What is this? Weight 1. Now, if you multiply this, how much you will get? How much? 5,000 into 1 is equal to 5,000 rupees. Okay. Now? So below this, second year. Let us assume you have 10,000 rupees profit. Okay. Second year, the weight would be 2. So here, multiplication you do, you get 10 into 2, how much? 20,000. Correct? Now, what do you do? So here weights, correct? No? So weights you underline. And here it is product. This is product. You underline, right? Below this, now you have to total. Now 1 plus 2, how many weights? 3 weights, right? Then 5,000 plus 20, how much? 25,000. Correct? Got it? Now, I must write where there is no space here. I'll further, yes, go for here. Yeah. Now, what is the formula? Formula says, wait, I'll write here. This is right. What is the formula? Total product. This is total product, 25,000. Total weight, 3. So, 25,000 divided by 3. So, 8,000 plus you get, correct? That is approximately I'm saying. Okay. So, 8,333 approximately is the what? Weighted adjusted average profits. So kindly note this. Years you will write, given profits, and weights you will write. First year 1, second year 2, third year 3, fourth year 4, fifth year 5. What do you do? Total weights you will total. So 1, 2, 3, 4, 5. Okay. Here, first year profit, second year profit into weights you will do. So you get the product multiplication. So 25,000 divided by 3 is what? Weighted adjusted average profits. Got it? Okay. Now the calculation of goodwill. So here, adjusted average profit into number of years of purchase, which I have already explained. So let us do one thing. Let us cover one illustration that would be better. Simple average profit method. Okay, there are 2 averages. One is simple average, another one is weighted average. This is simple average profits method. Mr. Amar has been doing business, intends to sell his business on 1/3/2015. From the following particulars, ascertain the amount of goodwill. Okay, 1 minute. I'm sorry, wait. Yeah, goodwill. See, on 3 years purchase of average profits of last 4 years. That means average profits of last 4 years means for 4 years profits are given to you. So calculate the average profits and multiply by 3. You will be getting the goodwill. The profits of last 4 years. So 2011, 12, 2 lakhs. 2012, 13, 2 lakh 40,000. 13, 14, 3 lakhs. 14, 15, 3 lakh 60,000. At the time of acquisition of business, mind it, what is to be added, what is to be subtracted. The buyer was employed as a manager of similar business on a salary of 6,000 rupees per month. Remember, the buyer was an employee as a manager in another business. After purchasing this business, he cannot go for work. That means monthly he was getting 6,000 rupees income. Now, per annum, 12 into 6,000, 72,000 rupees. After starting, that means after buying this business, He cannot go for work. He cannot earn. So that means per annum, he will be losing 72,000 rupees income. Okay. So that means from the existing profits, 72,000 rupees is to be subtracted. The profits of 2014-15 include income from investment 20,000 rupees. So in 2014-15, how much profit is given? 3,60,000. But in this profit, 20,000 rupees is income from investment. The proprietor of the previous business, he had done the investment. So on his investment, he got the dividend. That is a benefit. Now you are purchasing the business. For you, it is not the income. For the previous proprietor, it is the income. Now you have to subtract from 2014 profits minus 20,000. The profits of 2011-12 were reduced by 60,000, being loss on speculation. So you are purchasing the business, right? In 11 and 12, how much is the profit? 2 lakh rupees he has shown. But he has lost during that year 60,000 rupees loss he has booked. This loss, it will not incur in your business. It was his business, he has included. So now this loss is to be removed. Then for 2 lakhs, it is to be added 60,000. Speculation means stock market, right? Stock market investment causing him loss. Similarly, in 2013-14, profits were reduced by 1 lakh due to loss from betting. So 13-14 also he says, correct? In the 13-14 here, so 3 lakh rupees profit is shown, but it is actually to be 4 lakhs. So why? 1 lakh rupee he has lost from betting, so which is to be added. What do you mean by it? So what is that we are doing? We are adjusting the profit. See, that is the first step. Step number 1. Okay, statement of adjusted profits. Given profits 11-12, 12-13, 13-14, 14-15. What I have suggested, first, remuneration to the proprietor. What is to be done? You have to subtract. How much? 6,000 into 12. So it's this year, okay, 11, 12, 12, 13, 13, 14, 14, 15, 72, 72, 72. What is that you have done? Less, minus. Why minus? Henceforth, after purchasing this business, you will not go for work, you will not earn. So that much money you are losing. So 1 lakh 28, 1 lakh 68, 2 lakh 28, and 2 lakh 88. Because the profits were given 2 lakh, 2 lakh 40, 3 lakh, 3 lakh 60,000. Now, interest on investments. Which year he said? Interest on investments was received. Okay, 2014-15. How much? 20,000. See, 2014-15 last column. Okay, so here it is nil, nil, nil. How much you are subtracting? Minus 20,000. In the 2014-15, you are getting 2,68,000. Now, so there was loss due to speculation. See, loss due to speculation, which is to be added. Which year is said 60,000 to be added? 11 and 12. So here it is plus. Okay, 1,88,000. Then non-recurring loss due to betting. Okay, so see, there is betting which he has done in year 13-14. See, 13-14 minus 1 lakh. So now you get adjusted profit 1,88,000, 1,68,000, 3,28,000, 2,68,000. Now the profits are oscillating. Oscillating means they are not either increasing tendency or decreasing tendency. So you would follow simple average profit method. That's the second step. So in the second step, you are calculating adjusted average profits. So simple average profits, how do you get? See this 1,88,000 first year, 1,68,000 second year, 3,28,000 third year, 2,68,000 the fourth year. Total is 9,52,000. How many years? 1, 2, 3, 4 divided by 4. You get 2,38,000 rupees. It is what? Adjusted average profit. Now what is goodwill? Adjusted average profit into number of years of purchase. In the sum they said, so we found out that 2,38,000 How many years purchase? 3 years. So here we are getting 7,14,000 is the goodwill. Okay. Kindly revise. Okay. Review once again. Revisit. Replay. Please write the notes and learn the format. Then try to solve the sum. So this is Suresh Babu from Government Facility College, Gauri. Wishing you all the very best. Quickly respond to me on my mail, surs6980@gmail.com. So please watch the complete video. Thank you.